My name is Ian Slater and I'm the founder of Trove. Today, I want to speak to you about the many popular misconceptions in our industry surrounding the recent Fed interest rate cut. Recently, the Fed cut the baseline interest rate half a percentage point, or 50 basis points, down from the historic high levels that we've seen since inflation started to spiral out of control during and after the pandemic. For the past couple of years, we've seen interest rates get higher and higher and higher, sustaining at levels that we haven't seen in several decades. This means that many people my age have seen interest rates higher than we've ever seen in our entire lifetimes. Student loan debt, mortgage debt, credit card debt, any type of financing has been higher than it's ever been before. So it makes total and complete sense that there's an amazing amount of giddiness in the economy when the Fed decides to start cutting rates and we've conquered inflation. What we've seen across a lot of social media, a lot of talking heads on TV, and from a lot of real estate agents' mouths is that this Fed cut equals an exact drop in interest rates for mortgages. The Fed does not control mortgage rates. For a second time, I want to drive that home. The Fed does not directly control mortgage rates. The Fed only controls overnight bond rates. Single night bond rates. They do not control longer term yields. Longer term yields are based on the 10-year Treasury yield, which is a completely different interest rate than you're seeing from the Fed. A mortgage rate is based on the 10-year Treasury yield plus a spread. The spread is different from person to person. It depends on your credit score, your lendability, and I'm never really going to be able to tell you exactly what your rate is going to be until you speak to a banker or broker directly and they run your credit and give you the rate of that day. Sometimes the rates can change within the same day, so you really need to speak to somebody about what your rate is in that moment. Now, the overnight yield does affect the longer term yield, but the longer term yield will typically be priced in with expectation before the Fed cuts the rates. For that reason, this time, when the Fed cut the rates by 50 basis points, the mortgage rate was already kind of priced in. It had actually fallen for the several weeks in expectation of the Fed meeting. The day that the Fed meeting happened, the mortgage rates largely went unchanged. But there's a lot of different things that this interest rate cut affects, which is going to affect the New York market. I could speak for days about this, but a couple of things. The general sentiment in the New York market is immediately better when mortgage rates go down. People expect them to fall further, which means more people are comfortable moving from their low interest rates and more people are comfortable buying in. Also, if you look back historically at the recent peaks in the real estate market in modern history in New York, really 04 to 07, 2013 to 2015, 2021 to 2022, that's when mortgage rates and interest rates were at their lowest. All three of those times were after crises, right? 9/11, the 2008 financial crisis, and then COVID. That spurred a lot of buying in New York City. If there is a future time that New Yorkers expect interest rates to be really on ground level, they're going to buy in with a lot more vigor and a lot more tenacity. Lower interest rates also mean that business people can use better leverage to grow their businesses, which means that the wealthy buyer in New York City typically will use leverage to grow their business. And that means they are going to become wealthier, more wealth is going to flood the market, and it's going to help the market. Now, lastly and importantly, it really affects supply because all those developers out there who have deemed it too expensive to finance land and too expensive to finance construction now can finance it more cheaply. If the interest rates fall further, more and more developers will find it more advantageous to purchase and build in New York City. That will free up more supply in the city that we have been yearning for several years. Now, many people are asking how this interest rate drop is going to affect the real estate market across different price points in New York City. There's a huge conception that the ultra wealthy never finance, and that's why the ultra wealthy market has really sustained for the last couple of years, and those in the sub 4 million range are really stuck. That is also sort of a misconception. The super wealthy may not be getting mortgages, but they're getting private financing, credit lines, bank financing that might not be recorded as a mortgage. That also will be freed up a lot by having lower interest rates. Where this market's going to change a lot, I think, is the sub 3 million market, where people are really frightened of financing or they're holding on to 2-3% rates that were all of a sudden 6%. When those rates go down to 5, 4, maybe into the high 3%, a lot of those people are going to flood back into the market and attempt to purchase or trade up or move. Coupled with the additional supply that you may see in the coming future from developers and those buyers selling their apartments, you should see a healthier market. I don't expect prices to absolutely skyrocket, but I do expect there to be more supply and more buyers. I think prices will start to go up because naturally, if you can finance more, prices are going to climb. So as you can really see here, this is not as simplistic as Fed cuts rates, mortgage rates are lower, market goes crazy. It is very important that you consult with a professional who understands the market in depth and can explain to you how the mortgage rates are going to shift and how it's going to affect your personal situation. As always, for any real estate related questions or concerns, I and my team are always available to chat, so reach out anytime.